All right, here we go. First, let me introduce myself real quickly. My name is Brad Forrester, and I'm the president and CEO of the Con-Am Group. We're a developer, acquirer, and manager of apartments around the country. But as importantly, I'm also a proud member of the Policy Advisory Board of the Burnham-Moores Center. It's a great institution. I am just absolutely thrilled to have been asked to moderate this panel. In addition to the fact that we've got three guys who are very bright thought leaders, and they're on the front lines of capital deployment. At the same time, they represent such a broad range of the capital that's so important to our real estate industry, from traditional straight debt to pure equity and every structured product and flavor in between. So we're very fortunate today to have this group. I'll remind you again that their detailed bios are in your program, so we'll dispense with that. But let me just quickly introduce them to you. To my immediate left is Robert Brunswick. Robert is the co-founder, chairman, and CEO of Buchanan Street Capital Partners, or Buchanan Street Partners, I'm sorry. To his left is Chip Fidalin, who is executive vice president and group head of Wells Fargo's real estate banking group. And to my far left is Bill Lindsay, who is a founding partner of PCCP. So before we get started, let me give a quick disclaimer. When you looked in your program, you were probably saying, why in the world would they have picked a consumer of capital to moderate a panel with a bunch of providers of capital? The odds are Brad's just going to kind of lob up a bunch of softballs and everything. But first off, the disclaimer is that I have done business with none of these guys actually at this point. But more importantly, as they've gotten to know me, they have all said there is no way they will ever do business with me anyway. So completely conflict free. So let's get started. To provide a bit of context, I'm going to ask each of our guys here to tell you a little bit about the activities of their firm and what they're involved in today. So let's start with Robert.
Sure, thanks, Brad. Buchanan Street Partners, we're a real estate investment management firm. We manage money for pension funds, insurance companies, and high net worth investors, where we kind of predominantly started our business some 12 years ago. I would describe what we do as we really participate in the capital stack from kind of $1.51 to the last dollar. So doing everything from participating debt to mezzanine debt to preferred equity to joint venture equity to buying direct.
Great. And Chip?
So I'm with Wells Fargo, and on the real estate side, we really have what we think is probably the broadest platform in the entire industry post-merger with Wachovia. In the past, I would describe ourselves as a pretty conventional real estate-oriented commercial bank. But today, with the addition of the new businesses, we really go from traditional investment banking through the whole spectrum of commercial real estate lending. And then, because we own East Secured, really having the asset sales component, the ability really to look at the left side of the balance sheet as well as the right. So it's a very vibrant, deep, and active real estate platform.
Great. And Bill?
PCCP, we're a real estate investment manager like Robert. Our investors are mostly public pension funds. We have about $6 billion under management, half debt, half equity.
Great. So that gives a little framework for some of the responses you'll hear over the next several minutes. Let's start at kind of the high level a little bit. When we had our prep call, we all acknowledged that none of us are economists. However, it's important for all of us in running our businesses to have some sense of what economic assumptions we're making on a go-forward basis over the next 2 to 3 years. So let's start with that. I'm going to start and throw that out to Bill. Bill, what assumptions are you making as you look forward for the next couple of years in your business?
Well, it's I would say a super challenging investment environment today. We have low cap rates on products that are actually trading. We haven't gotten back to 07 levels on a price per square foot level, but it sure feels like we've gotten there on other metrics for some trophy office, for apartments, and not yet for hotels, but that's coming. And so what we try to do is underwrite where we're going to be in 5 years, and that is a giant challenge, but we assume interest rates are going to be significantly higher, cap rates are going to be higher, rents may be higher, we're not sure about that.
Great. And Chip, how about you?
Well, I really like being in the middle seat because you never have to go first, and I'm surrounded by a couple bright guys, so...
I'll get you in a minute, don't worry.
Okay, well, you know, I would say a similar outlook. I mean, I agree, first of all, with the premise that, you know, you've got to have a thesis and then construct a plan around that. The only thing I would say is that unlike my two associates up here, counterparts up here, it's a little bit easier today, in my opinion, to be a lender than it is to be equity because while Bill said a couple things that we do worry about, higher interest rates, cap rates, et cetera, today at least, we're still in an environment where high leverage deals are not getting done. And so to be able to lend between 55 and 65% of the capital stack, you can afford to be a little bit off. That cycle will change. So we worry a lot about interest rates. I think with the deficits the way they are, you have to be cognizant of that. But I do think that if we do start to run in an inflationary environment, that rents will inevitably follow.
Great. And how about you, Robert?
Absolutely, you know, agree with the guys, and Bill in particular. As an equity shop, we've been participating in debt because we can generate equity-like returns in debt. And we've been doing that because we very much believe in kind of a unfortunate slow growth, slow recovery model. If you look at the gentleman that spoke this morning, Mr. Williams with Fannie Mae, I saw a stat recently that Freddie Mac, some 45 to 50% of their recent financings were at lower loan amounts than the previous financing. So if you really believe in a deleveraging of our capital markets, which we think is taking place, then real estate is in fact going to act like it's supposed to act in most real estate institutional portfolios, which is more akin to a bond. So I think many of us have been used to real estate acting as much more of the alternative and the higher yielding performer in a portfolio, but I think we have to recognize where we sit at the table in regards to what investors want from our asset class. So with that being said, we, like Bill commented, believe that certainly cap rates are going to go up in anticipation of ultimate interest rates rising, and certainly inflationary kick-in from what's taken place with the federal stimulus.
So kind of sticking with that theme a little bit, you know, I'm reminded that 4 years ago at this very conference, Sam Zell spoke, and one of the takeaways I recall from that speech was that it was his belief at that time that it would take 8 to 10 years to soak up all of the excess liquidity in the world. So Robert, you raised this concept of deleveraging and so forth. Where do you feel like we are in the liquidity cycle, and especially obviously with respect to real estate and soaking up that liquidity?
I think the prior panel just spoke about all the jobs that are being realized now on Wall Street. I mean, the capital market creates its own inertia, and I think we all have to be mindful of that and careful as hard asset investors that we don't get caught up in capital's demands and capital's desires. Sam's obviously a smart guy, and I think capital in turn is smart and finds its spot in the area. And where I've seen capital move is really to get into commercial real estate. People have been buying banks and investing in banks because they want to get at the commercial real estate in those banks because there's opportunities in those areas. They've also been investing not in the private side of it, but they've been buying commercial mortgage-backed securities. So a lot of that liquidity is getting sopped up. When a year ago you could buy a CMBS senior tranche at $1,100 to $1,400 over, you know, that's a very attractive yield for that piece of the capital stack. So I think capital's finding its place and will continue to do so. Just briefly, I would tell you there's kind of a barbell deal. A lot of core buyers, a lot of opportunity money. We need to fill out the middle, which will happen over the next 2 years, I predict, and that capital will get put to work at some point.
From a banking perspective, Chip, how do you see it?
Well, you know, not to be glib, but when I came down to Orange County in early 1994, we had a massive vacancy issue in Class A office. And at the time, I think we had projected that we had 7 years of supply. About a year and a half later, we had 18 months of supply and nothing burned down. So, you know, I think that we're awash in liquidity right now, but nothing ever stays the same. And I agree with Robert that, you know, capital has a very uncanny way of finding the right home. And I think you can say the same thing about, there's a lot to be talked about with the sort of the tsunami of refinance and, you know, the the liquidity that will be needed to refinance all of the rolling projects, particularly 2014, 2015. But we said that in 2008, we said that about 2010 and 2011. So I'm pretty optimistic that, the markets really do find, in an aggregate basis, their equilibrium. They're never in balance. And I've been lending now a long time, and somebody said to me the other day, gosh, isn't it really a tough time to be a lender today? And I said, well, if I go back to 2006, it was a really tough time to be a lender then as well. It was just a different set of challenges. So I'm pretty optimistic that liquidity doesn't cause huge market disruptions.
So, one question that a lot of people have been asking over the last 12 to 24 months is, where's the distress? And Bill, I'll direct this to you as a raiser of massive amounts of capital. There were a lot of funds that were raised 36 months ago in anticipation of this major distress event. Where did it go, and what happened, and what's happened to all that money?
Let me give you some numbers. I'm a big believer that history repeats itself, and the macroeconomic rules that we learned in college, to the extent we learned things in college, are still in effect. So the market, the U.S. mortgage market's about $3.3 trillion or so. If we get back to the average amount of real estate debt to GDP today, just to do it right now, would be $1 trillion reduction in mortgage balances, commercial. There was $120 billion raised for real estate private equity in the United States between 2008 and 2010. 90 billion of that is uninvested. My theory is that is nowhere near enough to solve the problem. And as long as rates and returns stay low, I agree with Chip that the liquidity is there. He's feeling good because he has all of it. I think that you're going to see a lot of money flow into real estate, but only when yields go up to draw it in. The money's there, it's just waiting. And so one of the strange things that's happening in our business right now is yields are going down, at least maybe we believe they're going down, and money is coming in. And that's happening because there are no alternatives. Fixed income has no return in it. Rates are low. And what I struggle with in our business is that there are so many externalities that affect what we do. I was absolutely convinced that interest rates were going to go up last year, but who knew that Goldman Sachs did a deal with Greece and nobody knew about their deficit? And all of a sudden, flight to quality to the dollar, rates go down.
With that theme for a second, a lot of these funds have finite lives in terms of their investment periods. So to the extent that there was $120 billion worth of capital raised, the life of getting that invested is coming up, say, in the next 12 months or so. So what is going to happen with that?
I hate to be a cynic, but real estate private equity managers are incented to invest. They're not incented to sit on capital commitments and do nothing with them. I've scratched my head, and I'd ask Chip and Robert to reflect. We've seen some deals get done, and I was pretty convinced it got done because it was the last 6 months of the investment period of the fund in question that made the investment.
Just to add on that, I agree with Bill. I think most investors in these funds get it. They're much more sophisticated. We have a more improved workforce to a large extent with a lot of these investors. And in many instances, they're willing to extend the investment period to recognize that the market's backed up a bit right now. And I think if you look at public policy, if you look at what's going on with CMBS, anybody in here, I'm sure lots of CMBS borrowers, we were all concerned. First of all, it got us out of the last problem, CMBS. It created a public debt market. And everybody then's concerned, what happens if I have a problem with my loan and I got to actually go talk to somebody in the CMBS world, talk to a servicer. Ironically now, that's benefiting us because we're not having an unloading of all the CMBS, and it's onesies and twosies. But firms like ours, firms like Bill's, I think, are going to find we last year invested a modest amount of money. We put $250 million of equity to work. Probably most of that, 80%, was helping people recapitalize their debt, buy back debt from those lenders, those banks that have gotten healthy and are willing to now let some of their product go, sell their notes, or some CMBS servicers that have a fiduciary obligation to their bondholder and are willing to talk about a restructure of some sort. So I think it's going to be onesies and twosies. It's not going to be the RTC debacle that we have. And politics aside, I think that's going to prop up or maintain value in the industry as this slowly bleeds out over the next 3 to 4 years in terms of that money getting put to work.
I know you're not directly involved in the work outside of the bank. Jeff Reed, who's on our board, obviously is. But can you kind of talk to it from the banking perspective in terms of distress and the overall strategy that Wells is using to deal with distressed assets?
Yeah, a couple things, I guess. First, a lot has been made about this whole kind of pretend and extend concept, which, I think if it's truly pretend and extend, which isn't as easy to do, especially today in the regulatory environment that exists, maybe a little easier 18 months ago, but we're still seeing the same phenomenon, and that is a disconnect between cap rates and interest rates. And as long as you have that disconnect, and basically just to kind of take a quick example, if you take something, let's say something has about $1.5 million of NOI and it's an 8 cap, it's like about $18 million. And so if you were to, let's say you were to say that $18 million value property has $18 million of debt on it, so it's got no equity, it's 100% loan to value, that $18 million of debt would be priced at around 3.5%. Let's say LIBOR plus 325 basis points is LIBOR today. So something around there, that's going to be roughly, let's say, $500,000 or $600,000 of debt service. So you have $900,000 of free cash flow. If you put an 8 cap on that free cash flow, it's like $11 million. So somewhere there's something wrong, but what that has enabled banks to do is basically turn around and say to a good quality, competent borrower, tell you what, give us all the cash flow to start amortizing down the debt, continue to manage the property, you can live to fight a better day, we have a performing loan. And quite frankly, I think there was some intent, not that I have any window into what the Treasury or the Fed is doing, but some intent to let the industry sort of go on to the installment plan, so to speak. And I think that worked really, really well. It doesn't work very well when interest rates go up, but on the other hand, we've healed a lot of stuff. And in my business, the most expensive part of what we do is customer acquisition. Once you have a customer, to be able to lend into that customer, to be able to sell into that customer, it's a pretty efficient process. So if you've got a good customer that you've spent a lot of money to acquire, why do you want to put him or her out of business by simply foreclosing? We're not the best managers of assets. We do a good job. Jeff and his team do a great job, but we're not as good as the operating partners that Robert and Bill select. So it's worked out pretty well. Now, having said that, before the current environment, and I would tell you the regulatory environment has gotten a bit tougher. Whether it was not as tough 18 months ago by design, again, I have no window into that. But today, we get examined, 3 or 4 times a year by every alphabet out there from whatever regulatory agency there is to examine banks. And if we're pretending and extending without that cash flow, we'll get corrected. It won't happen.
Can I take Chip on? Sure.
Yeah.
So a frank admission of how the banking system works. If that project had $1 million of NOI, Chip would be facing almost a 50% capital loss, but the loan would be performing. And if you look at loan performance now, I think a lot of people, I'll go out on a limb and say, a lot of people think that this real estate recession is worse than what we went through in the early 90s. But if you look at loan default rates, they're nowhere near as high. And I think that what's happening is everyone is looking the other way, and when we stop looking the other way, this distress will come to market. So Chip's able to have a loan that has 2 or 3.0 debt service coverage and a 50% capital loss at maturity, and it's performing. And Robert and I are calling him up every day and saying, sell us that loan, you're going to get killed. And when he starts selling, that's when the action will happen. And I don't think that's going to happen until his cost of capital of holding that loan gets high enough, or he's at the end of his workout pile and he wants to get rid of the rest of it to look at new business.
Right. So I think that there's definite truth to that with one caveat. And if we go back to the beginning and talk about our thesis and what we think is going to happen economically, if rates go up but at the same time rents go up, then the hope would be that you've delevered this thing enough and that we're basically going to inflate our way out of it. If it doesn't happen, then you're absolutely right.
So I was chasing a mortgage portfolio, and it took forever for the bank to react. It took so long that the assets earned their way out of the problem, and they went from 140% loan to value to like 90 and sold it all to a very liquid apartment market. So extend and pretend, and it does turn into resolution sometimes.
In the CMBS world, you see all these graphs showing this mass amount of debt that'll be maturing over the next 2 and 3 years. Obviously, servicers are working, in a little bit different environment than commercial banks. But how is that problem going to be resolved? And are there opportunities from an investment standpoint in the CMBS world that perhaps don't exist in the commercial banking world? Robert, what do you think?
You've got probably $800 billion of your $3 trillion is CMBS bonds out in the marketplace. So it makes up not an insignificant part of the debt market. So it's a reality that there's going to be help needed. And to Bill's point, it's not a matter of if, it's just a matter of when. Our own belief is it's going to be onesies and twosies and managed by these servicers depending on their sub-tranche debt holders. So I don't think it'll be a clean and orderly exit. And it's going to be firms like ours, and there's plenty of capital out there to come in and bridge the refinance, either with that existing lender servicer on a restructure or with a new capital provider like Wells coming together with someone like us to recapitalize that transaction. But we have in fact seen CMBS servicers begin to take discounts as they act in a fiduciary capacity for their bondholders. So there's certainly an opportunity. It's not an easy product or investment to access and work through in terms of the system.
Yeah. Any other thoughts on that, guys?
In my view, the top three, excluding bank servicers, the top three independent servicers have changed hands in the past 2 years to Very Smart Capital. There's a reason for that. I think there's more money to be made in servicing. And if you start to, one of the lessons I learned is that in the boom when we were all moving so fast, our documentation probably didn't get the attention it deserved. And in CMBS, because no one had been through this default scenario, the rules are being made as we go. I think there's a giant opportunity in servicing. The question is, how is it balanced with the fiduciary duty you have to bondholders? And I have my suspicions as who's going to win that.